What's been happening in the market? And more importantly, what does that mean for you? Welcome to LVZ Market Minutes, the quick and refined update designed for savvy investors who value clarity over clamor. Our team breaks down the trends, movers, and the headlines that matter so you can stay informed and cut through the noise. Let's dive in. Past performance does not determine future results. Securities offered through Harbor Investments, Inc., member FINRA SIPC. Investment advisory services offered through LVZ Inc. LVZ Inc. is a federally registered investment advisor.
Joey, nothing is more spooky than a Federal Open Market Committee meeting and discussing rate cuts and if they should or shouldn't happen. Today is Friday, October 31st, 2025, when we're sitting down to discuss things today. And I really appreciate your insights. You make it fun, you make it easy to digest, and we're hoping that's what the average investor can gain from today's conversation to digest some of those spooky, maybe not so spooky headlines and talk about inflation, unpacking the latest Federal Open Market Committee meeting press conference and what that really means for them, and also exploring how investors can keep their cool while the market decides whether it's time to celebrate or nervously sip its coffee as things unfold. Related to that, we've also been in a government shutdown for the last couple of weeks. While it's been shut down, some of the economic data that's been critical for making decisions, especially related to policy and some of the Fed's decisions for lending rates, some of that data has been certainly delayed. Some of that has been able to be pushed through. How has that impacted things from an overarching standpoint?
Overall, it's good to remember that you can see the distinction between public policy and markets in times like this. A government shutdown is a very big story. It's not inherently a market story. These are companies, especially if we're looking at U.S. equities, these are not government companies. They're companies that are operating under their own process. There's oversight from various institutions, but they are not directly linked to what the government is doing. And so a government story such as the shutdown is very significant. There's a lot of people being affected by it. It's very relevant. It's very important to be aware of what's happening there. But again, it's not inherently a market story. And so how we operate within the markets and how we operate as investors, it shouldn't be shifted or thrown about based off what's happening in the public policy space. But yeah, as you said, some of the data that we like to see come out as far as how the economy is doing has been delayed, and that makes people a bit anxious. They're a little worried. So going into the Fed meeting this month, it wasn't quite flying blind, but it wasn't quite as informed as maybe people would have wanted the federal committee to be.
As far as data that has been released, the Consumer Price Index, the CPI, year over year sits at around 3.01% as of October 2025. Inflation has fallen dramatically since its peak at 8% in 2022, but it's plateauing right around 3%, which is where the Fed has been held up in the last several months and where that number has stayed. Tell us about the landscape of where we are in the inflation story right now, Joey.
Like you said, it was coming down pretty consistently, has started to tick up a little bit. Seems pretty consensus directed to the tariff situation. Those are, in theory, one-time price hikes. Powell mentioned in his speech that how they navigate those changes in prices can potentially have a knock-on effect to whether those become long-term systematic increases in inflation. But right now we're hoping that this is just a one-time effect of the tariffs. The prices will go up, but we are at, as you had said, year over year, 3.01 is what it came in at, and that's the highest it's been since about 2024. I think halfway through there. There'd been a little bit of a spike earlier in the year. 2025 came down again and is starting to strengthen up again there. So we're keeping an eye on it. The Federal Open Market Committee is obviously keeping an eye on it. But one thing that I did feel somewhat optimistic in what Powell was talking about is that they have suspended it's called quantitative tightening, which is essentially removing money out of the money supply to slow inflation. It's one of the two levers that they can pull as far as money in that space, how much is in the economy. So to see that they are not fighting the inflation specifically with everything they have, it indicates a little bit that maybe they are confident that these are one-time increases in price and not going to be long-term effect.
Sure. Are there any areas in particular, whether that's housing, food, or services, that are still running high or running hot?
Yeah, pretty specifically, the energy space is high year over year. Beyond that, it varies across the board. All items, again, that average at about 3%. Food is roughly at about that 3%. Commodities, they're coming in a little bit lower. All items less food and energy, which is what people look at as sort of the core inflation. Again, it averages out to that 3%. So it varies across the board. You're going to see a little bit higher in some industries, a little bit lower in others. I think the consumer is going to see it the most in their groceries. As we have some of these weird import situations going on with the tariffs as far as how much it costs to bring food in, move food around. If there's stuff coming across borders, suddenly that's a lot more expensive. And there's a knock-on effect there. I would assume that's probably where consumers are going to feel the stress the most.
It's been going on in that 3% range for quite some time now. Is that a new normal? Do you feel like consumer sentiment is adjusting to that?
I don't know if anyone fully adjusts to it in the sense that nobody ever likes inflation. Nobody's ever comfortable or very okay with above expectations inflation. The idea is we've been sold this idea that target is 2 to 2.5, and that if you can grow your wealth, grow your income, grow your net wealth at the bottom line faster than that 2.5, then you're going to retain your purchasing power. When that starts to fall apart, the consumer starts to question the storyline they've been told. It's never going to be comfortable when that inflation is higher, and it does cause you to ask questions and say, how does this work? If I was told that under a 2.5% inflation environment, this process works, but now we're at a 3%, does the process still work? What needs to change? And so that's where the anxiety can come in for an investor, and where it's important to talk to your advisors and say, hey, it's been higher than this 2 to 2.5 inflation for a while now. Does the plan need to change? Am I on track to retain the purchasing power I need for my retirement? Ideally, your investor is ready to have those conversations and is aware of the situation and knows whether or not you're still on track for where you need to be. They can adjust for today's dollars and futures dollars. But yeah, it's always going to be a little bit anxious when the inflation is high. And so I don't know that a consumer is used to it. I don't know that a consumer likes it. And so I don't think that the target to get it down to a 2 to 2.5 range should change. As consumers, as people investing, that should still be what we are trying to hold the powers that be to the extent that they can as what the target should be.
Sure, that 2% goal is in sight, but getting to the last bit of your goal is typically the hardest part. It's the last 100 meters of your run. It's the last 5 pounds that's trying to come off in a weight loss scenario, trying to get a millisecond better at something in a manufacturing process. It's that last little sprint that is often the most difficult. While consumers are seemingly adapting, that sentiment, of course, is still a little mixed. So coming off of that, the key metrics in the discussion from Federal Reserve Chair Jerome Powell's press conference on October 29, he had a couple of quotes that we'll pull out from there. He said the December meeting is not foregone. As far as a conclusion, it's far from it. There's a lot of discussion that needs to take place between then and now, and certainly with some of those key data points that we're missing from our departments that are currently not operating. Also, our long-stated plan has been to stop the balance sheet runoff when reserves are somewhat above ample levels. And I'll pull out one more. In December, we will enter the next phase of our normalization plans by holding the size of our balance sheet steady. So as far as Powell making it clear December's decision isn't locked in, what do you think that he's signaling from those remarks?
I think he's reiterating that, again, with him saying it's not a foregone conclusion, it's reiterating the autonomy of the Fed. And one thing that's important to distinguish, especially in the midst of a government shutdown, is the Fed is not the government. They're both overseeing bodies of the U.S. economy, but they are not one and the same. A government shutdown does not mean the Fed doesn't work. And so there's been a lot of conversation and push and pull on how much control of the Fed does the government have. And him saying it's not a foregone conclusion is not a direct response to him saying you don't control us, but it is reiterating their autonomy and the fact that they need to see what they need to see before they'll make a cut. Maybe that's strengthening job market. Maybe that's a slowing of inflation. But what I think he's trying to say is it's the environment needed to assume a cut. We don't know for sure that that will be the case. One, that could be because the data is delayed. It could be because we are seeing a slightly weakening job market, and there's conversation about what that's coming from, whether it's immigration, whether it's AI. Could be any source of input that's affecting that. And then with the inflation, again, that could be one-time price hikes from tariffs. It could be more of a systematic shift in the direction of where prices are going. They just haven't seen enough to know confidently what they'll do in December. So that's what they're going to be basing it off of. It is encouraging to hear him say we are initiating the next phase of the normalization plan, which is to get things back to normal, sort of post the COVID explosion of monetary policy and fiscal policy and public policy. Mm-hmm. Every rule in the rule book was thrown out the window to try and adjust for that. And if we can get back to a normal space, that's obviously what's going to be best.
As far as projections from the CME FedWatch tool, what are those projections looking like as of October 31st for our December potential rate cut?
Right now, the market is looking to price in at about 65% likelihood that they will cut another 25 basis points, 0.25%. That is down from before the meeting. Prior to the meeting, it was looking much more likely. And so hearing those comments from Jerome Powell saying this is not a foregone conclusion. Do not assume that just because there's a meeting that we're going to cut in December. So that it definitely pulled it back a little bit in the assumptions of what will happen. It's still likely. That's still the more likely outcome, but it's certainly not a given.
How does this align with market expectations and how companies are responding from lending standpoint, from being able to invest in R&D or take on additional capital for their businesses in Q4?
At this point, with earnings coming through, we're in the midst of earnings seasons right now. The companies are still looking very strong. They're coming through with strong earnings, and so they don't seem too wavered by the uncertainty of a government. They don't seem too wavered by the uncertainty of rate policy. And that's always good to see when you can see something not so dependent on a different variable, that it gives more autonomy to the companies to do what is best for them, for their shareholders, what can benefit their clients, and ultimately generate a strong outlook for them currently and in the future.
From the Fed shifting from tightening to neutral, but not yet easing, the options are still open for what they do in December. It remains data dependent. It's certainly not a guarantee, but looking optimistic at this point, just by a small fraction. Ending the balance sheet runoff, that reduces pressure on liquidity, and it creates a mild tailwind for markets. Do you have any other comments on ending the balance sheet runoff?
They found themselves slightly above the historic average of what is the Fed balance sheet as a percent of nominal GDP. They're expecting the treasuries that they're holding to continue to run off. They will look to sell some of the securitized securities and try and shift to just treasuries on their balance sheet. That number will still continue to come down authentically through the runoff of what they're currently holding. They're just not actively engaging in the quantitative tightening that they were doing before.
So let's talk about how the market's reacting to that and investor implications. Obviously, markets are responding with cautious optimism to everything going on right now. As of yesterday, October 30, Meta made an announcement on investing more heavily into AI, and the market reacted somewhat negatively. But of course, we know that past performance does not determine future results, and markets go up and down every single day. Stocks this morning opened a little bit higher. Bond yields are easing. Investors are reassessing sectors and valuations. How does this impact investor portfolios overall?
I would say from an investment standpoint, the horizon that we're looking at hasn't shifted massively. There's the little topics you indicated, the Meta earnings call, and that's always good insight into one of the leading companies of the hyperscaling. It's good insight into a company that is engaged with a lot of consumers and has good insight into what the consumer is doing. As far as overall landscape shifting, we don't feel that anything has changed. And so no changes are being considered or made in the portfolios. The allocation is staying the same. We feel well allocated for the current market environment. And so it's good information, but it's nothing that's causing us to whip back and forth or change our mind on anything. If anything, it's confirming the thesis that we've brought into this stage of the market and will continue with moving forward.
As far as market stabilizing, volatility is down comparatively from 2022 to 2023. Of course, every day is unknown. So as far as outlook for volatility, what does that look like from your projections?
It's always hard to know. And there's some level that you can't know. That's the point of investing, is that there's too many unknowns, and that risk is what generates the reward over long periods of time. That's the belief behind any investment, is that any short-term volatility or short-term risk you take on will be rewarded in the future by riding through that time. We'd love to see lower volatility. Lower volatility is great for the general investor. It helps them feel more comfortable with where they're going and how they're getting there. There's no real way to know exactly what will happen as far as volatility, with valuations still high. We are still in that environment where one headline can spark this knock-on effect of this company is overvalued, which means this company is overvalued, which means this sector is overvalued, and it can start to shift very quick from one environment to another there. There's always the potential for this next wave of volatility. In the interim, when we have moments of calm before a storm, we're happy to take that, but are being still very diligent with the allocations and making sure we're aware of everything in the market.
Sure, and investors are more equipped than ever before with data and insight into the actual valuations of companies or information that may drive a investor change or decision, and personal access to being able to do that. And so we're seeing that just at a very different pace than we have 10, 20, 30 years ago. So as far as Treasury yields and equity performance, what are we seeing in those spaces lately?
With the Fed rate cut, obviously that is just for the overnight lending rate, but it often trickles into the longer term treasuries and the longer term lending rates. So now with that, from a month ago, we're seeing all treasury rates short of the 1 year have come down a little bit from where they were a month ago. So that's a trend that you'd expect to see as the Fed rates comes down. You'd expect to see these longer term yields also drop. That starts to then, again, the Fed rate trickles into the long yields, which then trickles into something like the mortgage rate. And so it's not a direct one-to-one relationship, but you see it lag on and have some effects where the mortgage rates are starting to slowly come down. I still don't think they're at a rate that's going to loosen a lot of people away or pull them out of their 2 or 3 or even 3.5%, 4% interest rate that they currently have on the house. We'd need to see that come down a bit more before a lot of homeowners are looking to shift. But it is a good sign that the housing space can start to become maybe more affordable.
The markets are somewhat stabilizing as far as volatility. Yields are easing, suggesting that inflation is more under control, certainly not at the goal where the Fed wants it. But as far as diversification and patience in the markets with a long-term investment horizon, those still remain key strategies, certainly for our team and our investment outlook here at LVC. Looking ahead, what could potentially shape markets into year-end and early 2026?
One thing I've been looking into and reading and over the last few months is there's always the headline or the conversation about the seasonality of the stock market. It makes for good headlines. From an investor standpoint, there's not enough to say you should be making financial investment decisions based off what month of the year it is. So stay with the plan, stay rooted to your policy, stay rooted to what you're doing with your advisor. Ultimately, your ability to achieve your goals and achieve the cash flow that you need in the future and in retirement, that's your personal benchmark, and that's what you should be using as your northern light of, am I moving in the right direction? Making sure you have that very nailed down as to what you are trying to accomplish, it can help you stay on track. It can help you not have this drift of, oh, well, a month ago I was trying to achieve this, but now I'm trying to achieve this because I read a headline. And if you can really nail down what is the overarching plan and goal of your investments, it helps you stay the course much, much easier.
We were able to get the CPI data, the Consumer Price Index data, which ultimately some of the other information that's normally used at those Federal Open Market Committee meetings was not available. And so they were flying on private data and what was available. We're waiting for some key pieces like the core PCE, wage growth, anything else. What are some other metrics that we're waiting for that will hopefully be released when the government potentially reopens?
Ultimately, the big ones are inflation data. jobs data and GDP numbers. And so any delay that we have in that space is going to cause a little bit of tension because you're waiting and you sort of think you know what it is, but until you see the number, you can't know what it is. And you can only make so many real-time decisions based off assumptions of future numbers before you start questioning how solid these projections are. Those are the big ones. If we can start to get that, and obviously if we can get the government up and running at a full capacity again and have a consistent schedule for data releases, timely data is good data. Data that is where we want it, when we want it, and in the format we want it is the most beneficial and helpful to making decisions and understanding the environment. So the sooner we can get back to that, the better.
Is there anything else that you're looking forward to in Q4?
I think we've internally at LVZ been doing a lot of phenomenal work this year to refine process, refine practice, and it is building a foundation that I'm very excited for coming into the end of the year and in 2026 especially. I'm excited for what's ahead for our team and for this company. In that sense, less broad market, but more day-to-day focused of what we're doing here. I'm very excited about what we're doing, and it's a good time.
It is so fun to serve clients. It just really is. That's one reason I love coming here every single day to work alongside our team members. Certainly, there's nothing spooky about what we talked about today, even though it is Halloween. Inflation is cooling, but plateauing just above that 3% mark, and with the Fed pausing, not necessarily pivoting, and a balance sheet runoff ending with a cautious tone headed into December. We've discussed a lot of things related to markets being stable, forward-looking, cautiously optimistic, and still maintaining that strategy of diversification and avoiding emotional decisions. We've hit on that so much this year, especially coming off of a volatile 2022 market season, and making sure that you have that long-term investing horizon as your vision. Anything that we discussed today, if you want to learn more, make sure you check out the show notes for our links and resources that were referenced. And the Fed's playing it cool right now with a maybe, maybe not vibe heading into December. Markets certainly are optimistic that the worst is behind us. But of course, as we've discussed, past performance does not determine future results. Ultimately, the message for investors today, stay balanced, stay diversified, and maybe don't panic every time Jerome Powell clears his throat for a presser. Thanks for your time today, Joey. It's always ever insightful and makes markets a little less mysterious and helps us understand what that economic data actually is behind some of those confusing headlines. If you enjoy shutting down Halloween as soon as possible and turning on the Christmas tunes, check out the LVZ Songs of the Season over on our Spotify playlist.
That concludes this month's LVZ Market Minutes. Quick, clear, and curated to keep you informed and empowered. If you found these insights valuable, be certain to tune in each month for a strategic update. Until then, stay informed, stay invested, and have peace of mind that our team is actively monitoring the markets and managing your portfolios.